Today, we're tackling a really interesting economic puzzle. You'd normally think, right, that tariffs, those taxes on imports would make a country's currency stronger.
Yeah, that's the standard logic. Fewer imports, more demand at home, stronger currency, simple enough on paper.
Exactly. But look at the US dollar under President Trump's policies. Well, something else entirely seems to be happening.
And that's really our focus today. We're diving into why the US dollar is actually near its weakest point in about 3 years. It's completely defied what Wall Street expected, even with those tariffs in place.
So, we want to unpack the reasons, the effects, and, well, what this unexpected turn really means for everyone globally.
Precisely. Let's start with those expectations.
Okay, yeah. So Wall Street analysts, they were mostly expecting the dollar to get stronger in Trump's second term, weren't they?
They were. The reasoning seemed solid.
Yeah.
Tax cuts, boosting growth.
And tariffs cutting down on foreign imports. Both should theoretically push the dollar up.
That was the playbook. It seemed like a pretty safe bet at the time.
But the reality
It's
is,
starkly different. The US dollar index, that basket measuring it against other big currencies, it's down almost 10% this year.
10%. Wow.
Yeah, hovering around its lowest since 2022. It's shaping up to be one of his worst years in decades, actually.
Okay, so if tariffs were supposed to help, what's actually pulling the dollar down so much? What's the real story?
What's fascinating is that it doesn't seem to be the tariffs themselves, like in a vacuum. It's more about the intense uncertainty surrounding them.
Uncertainty. How so?
The administration's sort of back and forth on implementing them, pausing them, then hiking them up, then maybe lowering them again.
So it's the constant shifting, the unpredictability.
Exactly. That seems to be the big market mover here.
So it's less about the policy itself and more about the process, the lack of a clear path.
You've nailed it. Barry Eichengreen over at UC Berkeley, professor of economics and political science, he put it very simply. He said, investors don't like uncertainty. Full stop.
Makes sense.
And he argued that this lack of predictability has really dominated the markets this year, pushing the dollar down.
And that clouds the whole economic picture.
Right. It's led to this growing feeling, this consensus that U.S. growth is actually slowing down. The uncertainty breeds pessimism, basically.
Okay, so investors hate uncertainty. That feels intuitive. But is there maybe something deeper going on, more fundamental than just market jitters?
That's a really good question. And it points towards, well, confidence, or maybe a lack thereof. Arun Sai, he's a senior strategist at Pictet Asset Management. He suggested the dollar's fall reflects a kind of growing crisis of confidence in the U.S.
A crisis of confidence? That sounds serious.
It is. He argues that the sheer unpredictability from the U.S. administration makes it really hard to commit capital. So that old idea of the U.S. being the default safe place for global money, that's being challenged now.
Right. So it's not just numbers on a screen. It's about basic trust breaking down.
Yeah.
And that flip-flopping on tariffs you mentioned.
That seems to be a key trigger. Sai said exactly that the flip-flopping on tariffs was detrimental to confidence in the dollar.
Okay.
And get this, there was this very peculiar event back in early April. Tariffs were causing turmoil. And you saw U.S. stocks, U.S. bonds, and the U.S. dollar all drop simultaneously.
All three at the same time. That's unusual for the U.S., isn't it?
Highly unusual. For Sai, that was a really strong signal of this deeper loss of confidence. Things aren't supposed to move like that together.
A powerful signal indeed. But I mean, the dollar is still the world's main currency, right? Is its top spot really under threat long term?
Well, yes, it absolutely remains number one in most transactions. It's the most liquid, no doubt. But Francesco Pessola, he's an FX strategist at ING. He suggests its dominance might be starting to decline at a faster pace than we've seen before.
Faster pace. Interesting. Any evidence for that shift in sentiment?
Yeah, actually, a Bank of America survey from June looking at global fund managers, it showed their exposure to the U.S. dollar was the lowest it's been since 2005.
Since 2005. That's a long time. A significant pullback by the big players.
It really is. Shows a real shift in how major investors are thinking.
Okay, so we've got uncertainty, a crisis of confidence driving the dollar down. What are the actual tangible consequences of this? For the economy, maybe for people listening, are there any upsides at all?
Well, there can be some potential positives, yeah. Particularly for certain groups. A weaker dollar, for instance, makes American exports cheaper for the rest of the world. So good for exporters.
Okay, help sell stuff abroad. What else?
It can boost revenues for U.S. companies that have big operations overseas. Their foreign earnings translate back into more dollars.
Right.
And For anyone outside the US thinking of visiting, it makes a trip here relatively cheaper.
Yeah.
So potentially good for tourism.
Okay, so some silver linings for exporters, multinationals, tourism, but I'm guessing there are bigger worries.
That seems to be the consensus, yes.
Okay.
Jamie Dimon, CEO of JP Morgan Chase, he noted that the full impact of tariffs has yet to show up clearly in the economic data.
But the concern is definitely there.
Oh, yeah. Concerns are high. And the dollar is weakening precisely when worries are already swirling about erratic White House policies and, critically, the huge U.S. debt load.
Ah, the debt. How does the weak dollar connect to that?
Well, think about foreign investors who buy U.S. debt, like
Right.
treasury bonds. They want a strong dollar, right? Because when they eventually convert their holdings back to their own currency, a strong dollar maximizes their return,
But a weak dollar.
eats into those returns. They get less bang for their buck, essentially.
So if their returns are lower, they might start demanding higher interest rates to compensate for that risk, or maybe just buy less U.S. debt.
Exactly. If demand for the dollar, and therefore U.S. debt, starts to wane, then Treasury yields, the interest rate that the government pays, could drift higher.
And higher borrowing costs for the government. That eventually means higher costs for consumers, too.
It often does, yeah. It makes borrowing more expensive across the board. And this definitely feeds into worries about big spending plans, like the One Big Beautiful Bill Act and the overall deficit picture. It's all interconnected.
Right, a potential chain reaction. Okay, so if confidence in the dollar is shaky, and maybe it's harder to commit capital to the US, where does that money go? Is somewhere else benefiting?
That's a key part of the story right now. While the US dollar's been sliding, the European economy has actually looked relatively more stable, even though Europe faces its own tariff challenges, mind you.
More stable, interested.
Yeah, and this relative stability seems to be creating more appealing investment opportunities over in Europe. Capital's looking for alternatives.
And I suppose we see that reflected in the exchange rates.
Absolutely. The euro is up, 11.5% against the dollar just this year?
11.5%, that's a big move.
It is. It hit its strongest level against the dollar in over 4 years. It's a pretty clear sign of that shifting appeal you mentioned.
So, for listeners thinking about their own investments, what does this kind of global shift mean? Does it underline the case for looking beyond the US?
Well, Jason Blackwell, he's the chief investment strategist at Focus Partners Wealth. He certainly thinks so. He highlights some compelling reasons to diversify portfolios overseas right now.
Like what?
He points out that international stocks often perform better when the dollar is weak, like it is now. It really demonstrates the classic benefit of not putting all your eggs in one basket, you know?
Diversification.
Yeah. And Blackwell's take is interesting. He sees the dollar's dip less as just a negative thing for the US and more as reflecting a positive outlook for other parts of the world.
So, an opportunity to find strength elsewhere.
Kind of, yeah. Seeing it as a rebalancing, perhaps.
Okay, let's try and wrap this up then. What this means for you listening. We've seen the dollar's surprising weakness isn't just about tariffs, not really. It's deeply tied to the uncertainty those tariff decisions create. And that's fueling a kind of crisis of confidence among global investors.
Right. And this shift, it has really big implications, not just for the U.S. economy and its debt, but for where money flows around the world and the relative strength of places like Europe.
Which leaves us with a pretty big question to chew on, doesn't it?
I think so. Given this fluctuating confidence in major currencies and this clear push towards diversification, how is this going to reshape investment strategies for individuals, for big institutions, in the coming years?
And maybe even bigger picture. What does it mean for the stability of the whole global financial system if major players keep introducing policies that create this much uncertainty?
Exactly. Something to really mull over long after this deep dive.